BRRR stood for multifamily investing. So this is buying an apartment complex. You're going to rehab the apartment complex. You're going to rent it for a higher rate than what you bought it for, meaning you're bringing the rents to market rate. You're going to refinance it, and then you're going to repeat. So refinance, pull the initial equity out, and now you're going to be in the deal at an infinite rate, meaning no original equity is in it. Now you can redeploy that capital into another project. So we'll start with number one, the buy. So first, we're going to do our market research, property selection, and make sure that it's in a good area. It's a property that's worth buying, rehabbing, and then refinancing. Because ultimately, if it's not a good enough property, then we can't do the full cycle of the BRRR method. And then your financial analysis, a lot of times we'll go through and we'll see what items we can actually pick up off of the P&L statement, meaning if they've got cleaning fees that are too high, that we feel like are too high, or if they've got labor fees that are too high, we can compress the expenses on the property and make the property worth more when we go to refinance it as well. So that's part of the financial analysis. And then your negotiation. So of course your buy price, you'll always make money on your buy. If you buy it right, that's going to come through to the end when you can pick up the amount of money that you've saved just by buying it right. Due diligence, this is finding all of the what ifs before you actually go through to the purchase. So that's scoping the lines, that's checking the roof out, that's making sure that there's no internal damages that may cost money down the road. Because ultimately, you're going to go in with a CapEx budget, repair budget, but the more that you can find on the onset before you purchase it, the less surprise bills you're going to have, which then ultimately dilute your returns. So then we go to number two, rehab. So this is going to be off of your initial due diligence. You're going to have your budget put in place, what you're going in to do, what color scheme, what are you buying all new appliances? Are you replacing the cabinetry? Are you replacing the flooring? What do you need to do to those units in order to push rents to market rate? Are the units in original condition, or have they been rehabbed and you just need to put a cosmetic lift on them? And then even the rehab, you're sourcing your contractors. So you want to make sure that your pricing on your contractors are not retail, meaning you're not looking for the contractors that are going out there looking for customers and then selling their services to a retail customer. You're giving a lot of work to potential contractors. So with that, there's a trade-off. There's bulk pricing. There's lower pricing. You want to make sure you're procuring your labor and material at a wholesale price. Ultimately, that boosts your returns if you're doing it correctly. Make sure that all the work's being permitted. You definitely do not want the property to have municipality issues. And then make sure that the rehabs are properly project managed. This is checks and balances. You want to make sure that you're paying for what you're getting. If you've got craftsmanship issues or you have contractors that aren't fulfilling the full scope renovation, then that's going to bleed out to the end, and then it could be difficult leasing it up, and then ultimately it's going to cost you money down the road. Okay, so number three, rent. So this is where our initial market analysis, our due diligence part, we knew that the rents were below market rate. So this is where we're renting now at a premium because we've done all of the renovations to market standard. Now we're able to bring in a different tenant demographic and a different rental rate. So we want to make sure that we're marketing efficiently. We're doing our proper tenant screening. Ultimately, we don't want to put the wrong tenants in there that are just going to essentially be a warm body in the unit, meaning they're not paying. So we want to make sure that the tenants don't have any recent collections, no recent evictions. Just do your proper background checks, or make sure the property management company is doing the proper background checks, and make sure you're putting good quality tenants in place. Or ultimately, if you're doing a subsidy program, just still make sure that you're doing proper screening. Leasing, just make sure that your lease is able to be held up in court, or the property manager's got a lease that's able to be held up. And then occupancy. Once your renovations are complete, make sure that you're driving occupancy. There's a saying where if you're 100% occupied, then your rental rates are too low. While that can be true, you're still ultimately always pushing for 100% occupancy without giving concessions too. Okay. So now we're up to refinance. So this is where we go in and we get the property reappraised, and we're looking to pull out our equity. So if our initial purchase price was say 3.5 million, and our due diligence financial analysis said that we could push this thing to an $8 million valuation. Typically, a lender is going to let you refinance at a 70 to 75% loan to value. So this is where you can pull your initial equity back out of the property and then get you into an infinite return. So you want to make sure that you're looking at the loan terms. Make sure that your interest rate makes sense because this is going to be your long term debt. This is going to be where you're going into the sunrise. See a 30-year amortization or even a 40-year amortization. And typically you're going to see a 10, 20-year term on your longer term debt. And then, of course, that's where you cash out, and then you're closing. So that's the fun part, is when you finally have taken this thing full cycle, and you're able to take the equity out. All the hard work's paid off, and then you can go ahead, and the last step is now you repeat it. So you just go back and you start doing your market analysis and just do the whole thing over. And this is typically what you want to do on every single deal, because this makes a business. This is a full cyclical business, and enables you to keep doing more deals, bigger deals, and keeps it exciting. So again, I hope this helps. You can always reach out to me if you have any questions. Thanks again.